Winkler, Frankfurt School. I have a question to Paul, and it's related to his comment with regard to that quantitative easing is actually in the tradition of the Bundesbank, as you described, with regard to the monetary pillar. And I actually would completely agree with you, and I have some support, for example, in the recent blog post by Manfred J.M. Neumann. For those who are not familiar with the German scene, maybe the economic professor most related to what the Bundesbank did in the 70s and 80s. And he had in August 2014 a blog titled The Illusion of Monetary Expansion. And he meant the ECB, and he showed with very monetarist techniques that actually the ECB policy is restrictive. And he said, if you want to go back and reach your target, you have to do two things, as you mentioned. Either buying government bonds or you're buying private assets. But then he stopped. So he didn't recommend because he doesn't like neither. He doesn't like, and on principle grounds, he doesn't like it because government bonds buying runs against what is called your order liberalism, and private bonds means exposing the balance sheet of the central bank to risk, which also runs against the order. And therefore my question is, even if we would fill the incomplete contract, which you at the end alluded to, I don't think it will solve the economic debate and the economic controversy which we have in this country.
That doesn't sound like a question. You want to pretend it's a question.
Do you agree with me?
That's what I figured.
Thank you very much.
I think, well, first of all, the point about the Bundesbank. The Bundesbank was focused on broad money. One of the techniques for managing broad money targets in this continent and in my own country was to buy government bonds from the non-bank financial sector, or to sell, which was overfunding, or underfunding, or sell government bonds to the non-bank private sector, which was overfunding in my language. In that sense, this was a technique that goes back decades and decades, and in fact was used in the 19th century as well. The broader point about incomplete contracts is society needs to choose. It needs to choose whether it wants to have a central bank after the zero bound has been met. It could choose not to have, and then what would happen is governments could choose to, the solvent, high quality governments, could choose to shorten the maturity of their debt. And that would, or they could choose to issue more government debt of whatever maturity and buy private sector paper. This would have a very similar economic effect, with one big difference, which is because the decisions have been made by politicians with short-term incentives rather than by insulated central bankers, it would be impossible for people to be sure that the decision takers were truly dedicated to the goal of price stability. That time consistency problem, or problem of credible commitment, is the reason, and the only reason, it is legitimate to delegate so much power to unelected people. The division of labour between that independent central bank and the fiscal policy is largely a matter of convention, and to that extent, I was saying gently, the debate about quantitative easing in our continent has been fundamentally misconceived about what an independent central bank is, and I have found that almost distressing, frankly.
Another question? Yeah.
Thank you. Witold Grosser from the National Bank of Poland, the central. I'd like to follow on the idea that was put forward at the very last speech by Natasha Valla about the risk-taking of central banks, and you mentioned that the central banks might be in the future, or should be, risk-takers of last resort. I believe that they are already risk-takers of last resort. Probably your recommendation would be to be even more risk-taking, because they are backstops against many risks in the financial sector, not only for sovereign but also other sectors of the financial system. But I have a question to you and Sir Paul Tapper about this, because given that the size of the balance sheets of the central banks have increased quite significantly, and and still the macroeconomic facts in terms of rising inflation and inflation expectations have been, let's say, muted. Do you see any risks down the road for the central banks, even though sort of central banks do not have to employ market accounting and things like that, but given that risk, the true risk in the world, can be shifted, but cannot actually evaporate. Do you see this as a potential cause for concern for any type of policies that increase the size of the central bank balance sheet? Because you have a bigger balance sheet, you have a bigger exposure. I mean, irrespectively of what you buy and what the effects might be of this. Thank you.
Yes, I think the question of the risk taken by the central bank really has to be rethought, because we're in a world where we thought, okay, we have bonds, and bonds are financial instruments with a very specific risk profile or non-risk profile. We didn't want anything else in the bank's balance sheet, in the central bank's balance sheet, just for that reason. Now we realize that we have an environment where you can have bubbles on fixed income instruments, and you can also have default on issuers. And therefore, sticking to the narrow idea that by holding a bond, the central bank is safer than holding a real estate building or an equity, I think that's completely misguiding in the current environment. Also given the fact that there are areas of the economy that would need financing when the transmission is not restored, and therefore you would see there would be benefits in having a more direct financing of real economic activity. So that's in that sense, I would say let's stop being hypocritical about the risk that is on the balance sheet of the central bank, and be more open about the range of instruments that could be thought of as instruments being purchased, also in the context of, and this was really interesting to hear you on the independence of the central bank and this monetary fiscal independence, the prohibition of monetary financing. That would ease a lot of things if we didn't have to think only about sovereign issued debt securities when thinking about expanding the central bank's balance sheet.
Well, I certainly don't think there should be risk-taking other than in the context of pursuing a nominal stability. Otherwise, the central bank can just become a quasi-infrastructure bank and lots of other things. Once we're away from the zero bound, the central bank unavoidably takes risk. The way we chose to address that in the United Kingdom is that we asked for an indemnity from the government. Had the risk crystallized, with or without the indemnity, had the risk crystallized, they would have got less seigniorage, which means higher taxes or lower spending in the future. So the point of the indemnity was to make it absolutely transparent to the British public and to the Westminster Parliament and to the wider world that risk was entailed, and that we were pretending that it wasn't entailed, and the government understood that there was that risk, and therefore they understood that if the risk crystallized, they would get it. But that needn't interfere with independence, because it didn't qualify one iota the fact that we decided how much QE to do when and for what ends, which was achieving our inflation target. So again, this is another way in which the debates about what it is to be a central bank have become muddled, and I think need disentangling.
Just because this is making me think. It's so when the central bank buys government bonds, right? It is doing it because it expects to lose money on those purchases of government bonds, right? Because it's aiming to reflate the economy. So when you think about it, the whole idea is if the central bank were to buy depressed, risky assets, it would be helping the economy and expecting to make a profit. And until now, we've been doing that the central bank should only be buying bonds expecting to make a loss in order to hope that the portfolio rebalancing leads to a stronger risky assets. So it is a question really of, are we really to agree that when we do QE via government bonds, we are affecting credit allocation and portfolio allocation, but only in an indirect way? And therefore, is the 1 degree of separation something that makes us feel better? rather than just going to the extra degree and just doing it directly. And I guess in the next round of QE, if we are really unlucky to be in a secular stagnation, then we will have that debate.
I'm just going to use the chair's privilege since we're out of time very much and just pick up where Angel was. I think one thing which you've heard today, you heard Peter say it during his talk, you heard Eric saying it during his talk, is that if you want to have maximum impact from QE, you want to go where the spreads are widest or where the market segmentation is highest. And that's not necessarily going to be the government bond market. In fact, unless things are very, very bad, or you're Europe, it's not going to be the government bond market. And similarly, we were talking earlier with the ADB folks about the idea of macroprudential policy, that if you're going to be getting involved in things to stabilize the financial system, you're going to have to get involved in some specific asset allocations as well. And this is where I'm slightly agree with, slightly different from Paul. I think it is reasonable to say that you're doing this only in the pursuit of, say, price stability or financial stability, but that you may have to get your hands messy to do it. But this is going to be a question where I definitely agree with Paul, and I gather Natasha also agrees. This is a question of forcing your elected officials to actually make some decisions and give explicit either expansions or not of central bank powers. And then under the state of Fisher, you have goal dependence and instrument independence once you get that. Anyway, I'm afraid we're out of time because we are here on a Germanic schedule. In that spirit, I'd like to ask Dietmar Honong, who is running Sovereign Risk Group here in Moody's in Frankfurt,